Hello everyone, this is Professor Stanley, Department of Behavioral and Social Sciences, Louisiana State University, Alexandria. Today we're going to be discussing spending and taxing, otherwise known as economic policy, domestic policy, and the political sciences. A couple things to go over that we've discussed in this class so far. Uh, Differences between democracy and capitalism. Remember we have a balance here. I have something on the bottom for political parties, left for Democratic, right for Republican. Okay, and then there's always the center, people that are unsure. So basically, we have this balance when we talk about policy and objectives. Okay, the voting block. So normally, most of the people are here in the center, with very few on the right or on the left. The U.S. government's effect on the national economy is very influential when we talk about the federal budget and how it impacts the economy, things that we've learned about so far in this class. Uh, the tax code is very complex here in the United States for a number of reasons. We'll go over that, as well as some theories about the Democratic and Republican parties uh, when it comes to promoting economic policy and promises to promote economic policy. So, the government and the economy, linking these two things. Now, there are private and public forces at work in the market economy in the United States of America. You need to remember that. It is a mixed economy. Okay? Nothing is very specific about the type of economy in the Constitution. It's pretty much left up to the spending and taxing clause of Article 1, Section 8 of the Constitution, otherwise known as the Elastic Clause. Um, Now, tax policy. Obviously, the IRS handles the executive functions of tax policy, but tax policy is actually regulated by Congress. Um, Different ways of looking at taxes, a progressive tax and a regressive tax. Those who have higher incomes but pay more also have more deduction options. So that's just an example there. Different types of taxes. Capitalism and democracy. Remember, we discussed the idea of the left and the right, which is the premise of this course. One of the main premises of this course, I want you all to remember uh, the struggle between ideas and making policy and how it's made. So, people who have capital or the productive capability or capacity, business owners, um, are very much opposed to any type of more government regulation on their assets, obviously. But you'll find here in our democracy, here in the United States, it's a Western democracy, modern, um, we have social programs in place to help redistribute the wealth to people that need help, such as the Medicaid programs and the Medicare programs for healthcare. Now, capitalism and free enterprise is often thought of as American values. You learned about that in high school. We want to talk about that a little bit more in detail here in our setting. Market regulation and capitalism. Remember, again, we're talking about a balance here. Market regulation. Again, guys, I'm not an artist, so you'll have to forgive me. John Maynard Keynes was a very famous economist. He came up with what's known as Keynesian economics, and we'll discuss that a little bit more in detail later on in this lecture. But basically, you're going to find out if you study history that things occur in cycles, they are cyclical in nature. Boom and bust. We all talk about the economy, how it goes up and how it goes down. Well, the same thing with government regulation. And for example, the Great Depression and how the government had to step in and create more regulations. Okay, so the old way of thinking, if you will, the classical traditional way of thinking is that the government does not need to be involved in economics. Okay. Now, Keynes thought the same way. He thought that economics was about the short term and not the long term. Okay. More, we call it demand side economics. That was basically Keynesian theory. Keynes said that aggregate demand did not always equate to capability of production factors in the economy. Okay, and he said that outside forces influenced, for example, inflation or the rate of unemployment, those types of things. Now, what happens is the general public, people in society, expect the government to solve problems. Now, why is that an issue? Well, we just talked about some of the reasons why economists believe that the government is not necessarily always able to solve the problems. Things that always occur, unemployment, there is what's known as a natural rate of unemployment. Okay, depressions, we see those have occurred throughout history, and the natural rate of unemployment is actually around 2%, which means that at any given point in time, you're going to have roughly 2% of the workforce that is unable to find a job. Natural rate of unemployment. Depressions, recessions, what we call the Great Recession is the latest one we experienced with the housing market collapse in 2008. Again, things are cyclical. They happen over and over. Inflation. Every year we have inflation. Deflation. And this is just a note that something that the economists have came up with called the misery index, which is basically means what it says. It measures the amount of despair people have about the economy. If you take a look at what we were talking about, 2008, see the impact of unemployment right here. Notice what happens across the board. Unemployment actually increased on all groups of races, particularly in African Americans, Latinos. Now, you can draw your own conclusions from that. So, in terms of gender, recessions usually hurt male workers more than female workers, maybe because they're more of one than there is the other. Now, education, remember, degrees often give you safety nets. So, you are less likely to be unemployed when these things happen. Let's talk about spending for a little bit. The government spends money, right? That's what they do. Two types of spending, discretionary and mandatory. Discretionary spending, operating expenses and salaries for employees, for federal agencies, national parks. The book gives you more examples. Okay, Congress decides on how to do that each year. Mandatory spending is on social public programs such as Medicare and Medicaid, payment systems. They call them transfer payments. Government subsidies, interest on national debt, unemployment insurance, they are mandated by law. In other words, they are mandated, but they can ultimately be appealed for whatever reason. Now, here's an interesting picture in the book. I want you all to take a look at and see what that means. Normal circumstances, spending by the government is sufficiently small part on all economic activity. Again, spending is cyclical. It occurs when it needs to occur, and it recesses when it needs to recess. Now, if you want to look at the budget, you can see that healthcare is the number one federal mandatory spending item, and the number one federal discretionary spending item is the defense budget, the military. Okay, so why spend money? Growth stimulates growth, impacts economies both abroad and local. That's pretty much a summary of what you're looking at there. In relation to revenue, it is a little more difficult to explain. Spending, I'm talking about. It is harder to project the impact that the economy is going to have on the budget, okay, such as inflation and unemployment. And even the election process. We saw that the past election after Donald Trump won, the market dipped and ultimately hit record high. So, revenue, spending, and the national debt, budget deficits occur even when spending exceeds federal revenue in a single year. Okay, so these are some basic terms you need to be familiar with. You may see those again on the quiz. Now, the national debt is actually accumulation of all the budget deficits that the country has faced, which is at $19 trillion at this point. Now, deficits and debt economic health. Well, basically, we're in a lot of debt right now. And there are a lot of reasons why. We're not here to discuss the reasons why. What we're here to discuss is the science about it. Proponents of paying down the debt versus opponents of paying down the debt. Proponents of paying down the debt say the amount of money for annual interest payments are indebted to form interest. Opponents say debt has been constant for most of history of the U.S. Now, this is an important graph you want to look at here, U.S. debt relative to GDP. It is probably more around here, right at this point in time. Okay, so what that means is around roughly 70% of our GDP is the debt, basically. Taxing, achieving social goals. Remember those programs we talked about earlier? Well, they cost money, and no one wants to pay for them. Now, how do we do this? Well, we have to tax people. Now, undesirable activities such as the fat tax in New York and all kinds of luxury taxes are ploys by the government to discourage use. Payroll taxes. Where does most of the money come from? Well, you see it right here, individual income taxes. You'll want to review more about the tax code in the book. It talks a little more in detail about it than I'm going to touch on here. But for our intents and purposes, taxes do help to manage the economy and bring in revenue. Okay? Even though nobody likes to talk about it. Liberals seek a more progressive tax code. In other words, tax the ones that are more wealthy. Conservatives seek a more progressive tax code or equal tax code across the board. Contrast the difference between Republicans and Democrats. Here we go. You ready? Democrats believe that spending can help the economy and improve lives through public assistance and so on and so forth. Keynes was sort of a proponent of this theory in his writings and his work. Now, Republicans say that government should be less active, okay? So less intervention, fewer social programs,